Topic examines asset-backed security, ABS, instruments and their market features, focusing on the structure, risks, and characteristics of securitized products. Asset-backed securities are fixed-income instruments supported by pools of financial assets such as auto loans, credit card receivables, student loans, or leases. Through securitization, these financial assets are transferred to a special-purpose entity that issues securities backed by the expected cash flows from the underlying assets. ABS markets play an important role in global finance because they provide issuers with alternative funding sources and investors with diversified exposure to consumer and commercial credit markets. Understanding ABS structures is essential for fixed income analysis and risk management. Covered bonds are introduced as an important category related to asset-backed securities. Covered bonds are senior debt obligations issued primarily by financial institutions and supported by pools of high-quality assets, usually mortgage loans. Unlike traditional securitizations, the underlying assets remain on the issuer's balance sheet rather than being transferred to a separate special-purpose entity. Investors therefore benefit from dual recourse, meaning they have claims on both the cover pool and the issuer's general assets if default occurs. Because of this additional protection and the use of over-collateralization, covered bonds generally exhibit lower credit risk and lower yields than comparable asset-backed securities. One important feature of covered bonds is over-collateralization, where the value of underlying collateral exceeds the face value of bonds issued. This structure provides additional protection against losses arising from defaults or declines in collateral value. Regulatory requirements often impose limits on loan-to-value ratios within the cover pool to maintain asset quality. Independent third parties may monitor the cover pool to ensure compliance with these standards. Because covered bonds remain on the issuer's balance sheet, issuing institutions generally do not receive the same regulatory capital relief associated with traditional securitization. Nevertheless, covered bonds remain attractive to investors seeking relatively secure fixed-income instruments with strong legal protections and stable cash flow structures. Traditional ABS structures differ significantly from covered bonds because the underlying assets are transferred to a special-purpose entity and removed from the originator's balance sheet. The SPE issues securities backed solely by the cash flows generated from the asset pool. Investors therefore rely primarily on collateral performance rather than the issuer's overall financial condition. Asset-backed securities may be structured into multiple tranches with varying priorities of payment and risk exposure. Senior tranches receive cash flows first and typically possess higher credit ratings, while subordinated tranches absorb losses earlier and therefore offer higher expected yields to compensate investors for greater risk exposure. Credit enhancement mechanisms are essential components of ABS structures because they improve the credit quality of securities issued by the SPE. Internal credit enhancements include subordination, reserve accounts, and excess spread generated by the difference between collateral income and investor payments. External enhancements may include insurance policies, letters of credit, or guarantees provided by third parties. These mechanisms reduce the probability of loss for senior investors and support higher credit ratings. Effective credit enhancement structures are particularly important because ABS investors are exposed to risks associated with borrower defaults, prepayments, and deterioration in the quality of the underlying asset pool. The topic also discusses common types of non-mortgage asset-backed securities and their cash flow characteristics. Auto loan ABS are supported by consumer vehicle loans and generally exhibit predictable payment patterns. Credit card ABS are backed by revolving receivables and involve greater uncertainty because balances fluctuate continuously. Student loan ABS depend on repayment behavior influenced by employment and economic conditions. Lease-backed securities derive cash flows from lease payments and may involve residual value risk associated with underlying assets. Each ABS category possesses unique risk profiles related to borrower behavior, collateral performance, economic conditions, and legal structures affecting cash flow timing and credit exposure. Collateralized debt obligations, or CDOs, represent another important securitized product discussed in the topic. CDOs pool various fixed-income assets, including corporate bonds, loans, or other ABS tranches, and divide them into multiple classes with different levels of risk and return. Senior tranches receive priority in cash flow distributions and generally possess lower yields but higher credit ratings. Equity or subordinated tranches absorb losses first and therefore offer higher potential returns. Although CDOs can improve diversification and funding efficiency, they also introduce substantial complexity and leverage. During periods of market stress, deteriorating collateral quality can significantly impair lower tranches and amplify systemic financial risks. Topic ultimately demonstrates that ABS instruments and securitized markets are essential components of modern fixed-income finance. Asset-backed securities provide issuers with liquidity and funding diversification while offering investors access to structured exposures across consumer and commercial credit markets. However, these instruments involve unique risks related to collateral performance, prepayments, structural complexity, and credit enhancement effectiveness. Covered bonds, ABS, and CDOs each possess distinct legal structures and risk-return characteristics requiring careful analysis. Mastery of ABS market features enables analysts and investors to evaluate securitized products more effectively and understand their broader role in financial intermediation and capital market development.